Hello, my friends. Welcome back to another segment of Miami Revealed. My name is Frank Pichon, your host as always. Today is May 30th, 2024. Wow, 2024. What a year. We really are in the future. But anyway, today I have my honored guest, Minerva. We're going to continue to inform you about taxation, the law, how the law is written, and what is stated in the law. And we're going to continue about the, what chapter, Minerva?
We were talking about definition of states.
Let's go into that real quick,
Okay,
please.
all right. Under Title 26 of Title F, Chapter 79, it says here that the states, the term state includes Washington, D.C., the Commonwealth of Puerto Rico, Virgin Islands, Guam, and American Samoa. So there is no way here that we can find Florida. Is Florida here? No.
It's not mentioned.
Right, because as a rule, we need to remember that if it's not included, it's excluded. So we don't find
But we're
here.
talking about not just Florida. We're talking about the 49 actual state of America, in America,
Correct.
North America.
Right, we don't find here Texas, New York, California, Ohio, Kansas, you name it. They're not here. So when the IRS is talking about states and we go straight to their own definitions, then we find that we are excluded unless
We meaning Florida.
Floridians,
Thank you.
for that matter, because we are talking about specifically for Florida tax, property tax.
Correct.
Okay? Correct. Now, unless, of course, you like to make donations to the IRS under the false pretense that you are a taxpayer. But we have not gone yet to the definition of taxpayer. Would you like to know the definition of taxpayer?
I'm sure our audience would.
Alrighty then. So let's go to taxpayer. And under the Florida statutes, Title 14, I'm sorry. Subsection 192.00313 defines taxpayer as a person or other legal entity in whose name the property is assessed, including an agent of a timeshare period title holder. Now, are you a person?
What is a title holder?
Somebody that holds the title.
But, okay, somebody or something or some entity.
Correct.
Because I remember 6-7 years ago, this whole thing went up to the Supreme Court. And the Supreme Court ruled that a corporation is a person.
Well, let's go to the definition of person,
Thank you.
shall we?
Please.
Okay, so according to the Internal Revenue Code, okay, not my definition, not Google, not Wikipedia, let's go straight to the main source, okay? Internal Revenue Code, section 7701A1, the term person shall be construed to mean an individual, a trust, state, partnership, association, company, or corporation. But you know what? People get confused when they say individual. They think as, oh, you're such a nice individual. You know what I'm saying? Just
Yes.
like person. Oh, he's such a nice person. Oh, what a sweet person she is. Because we have been programmed to use these commercial words as our own identification. We identify with those things. But we have been programmed to do that so we can act as a corporation, as a dead entity. In nowhere you can find here the definition of a living, breathing man or woman.
That's very interesting.
Did you find it there?
No, of course not.
Of course not. It is not there. And as a rule, if it's not included, it's excluded. Okay? So, do you know who you are? This one, I'm going to be hammering it. Okay? Because it is very important to go back and assume our position of sovereignty. And we're going to get into that later on.
Very good word.
All right. So the Internal Revenue Code also says in the section 7701A14 that defines a taxpayer as any person subject to internal revenue tax. but any person. They can confuse you too with natural person, and most people think, oh yeah, they're talking about the natural person. Is there anything such as natural corporation, natural dead entity, or legal entity?
Well,
There's nothing natural about that.
no, they're just corporations on paper.
Yeah, it's a legal dead entity. It doesn't include here the living, breathing man or woman. If it's not included, it's excluded. Therefore, I think that makes us a non-taxpayer. By definition.
That is a very interesting paradox. Because if you don't pay taxes, they'll knock on your door.
But I'm going to tell you even more with the definitions that we have been discussing here. Do you live in Washington, D.C.?
No. I love it, but I don't.
Do you live in Puerto Rico? Do you live in Guam? Do you live in American Samoa?
No, we don't.
Or Virgin Island?
Love it, but no.
Therefore, you are not included in the territory that includes the taxpayers. We are excluded.
Well, I remember, because I'm a student of history, and I remember how corporations came about. And they came about in the late 1918, right after the Great War. I believe they started in the 20s. And what happened was Carnegie, Rockefeller, all these multi-billionaires that used to run the country, and they did. They had more power than the president and Congress. So when Congress passed the tax law, they ran and petitioned for Congress to allow them to create corporations. Now, what is the advantage of a corporation?
Well, the advantage of a corporation is that in the system that we're living right now, we are operating under commerce law. So a living, breathing man or woman cannot make a contract with another corporation. You have to make a contract also as a corporation.
Correct. And the reason why corporations were formed by these very rich people is because the way they wrote it, and it's written that way, because I have several corporations. I don't know if you do. And what you do with those corporations is everything that you can relate to that corporation or that company is tax deductible. So these billionaires, in order not to pay taxes, and they're still not paying taxes, the billionaires, they have corporations. And everything that they spend through that corporation is tax deductible, at least a great majority of it.
Yes, so I want to answer that question in a very brief way,
Sure.
because we want to stick to property taxes.
Go ahead.
However, all these corporations, they are filed where? They are filed in Washington, D.C. So although you don't live you don't live in Washington, D.C., you live here as a Floridian, your corporation is registered in Washington, D.C. And since your corporation is doing business with another corporation, which is the Florida, state of Florida for a private for-profit corporation.
Exactly.
And they are also registered in Washington, D.C., then that makes you a taxpayer. Your corporation has to pay taxes because you're registered with another corporation.
Of course. And it's funny because every year, at the beginning of the year, I've got to pay the state of Florida X amount of dollars to renew my permission to run my corporations out of Florida. Not mine, everyone.
But we can have another show for that, which is going to be very interesting. But as living, breathing men and women, as Floridians living on the land of Florida Republic, are we taxpayers liable to pay the ad valorem tax, which is the tax assessment for your private property land? That is the big question right there. That is the big dilemma. So let's
Explain.
ad valorem.
please.
All right,
You
let's
read
go
my
to
mind.
the definition. So let's go to Black's Law Dictionary, edition 6. And it says here, it means according to value. Okay, but listen to the next one. A tax levied on property. Which property? If it's not included, it's excluded as a rule. Which property are they talking about?
They've got a
It doesn't
name.
say there
Right.
land property. All
Let's say
right.
your doghouse or your garage.
Right, but wait a second. Or an article of commerce in proportion to its value. In other words, ad valorem tax is meant for commerce. So is your house being used right now for the purposes of running a registered business?
Okay.
So right now you have a couple of corporations, and if they are registered using your residential mailing address,
Yes.
then yes, because you're using your home. Although you might not be running your business from your home,
Right.
but you registered that business under the mailing address of your home. That makes you, that makes your home taxable because you're using it for commerce
Correct.
purposes.
Right. So this is the thing. Okay, so we have corporations that you can deduct expenses, but if you have a corporation in your home, you're already paying taxes for your home. And now, just because you have a corporation, you have to pay more taxes? That's like double jeopardy again.
Yes, but do you want to know what the state of Florida says regarding ad valorem tax? Would you like to know?
I would love to.
All
I totally
right.
want to. Right, guys and ladies?
Yes, absolutely. Let's go there. So I'm going to give you just a few of them because this is a lot to take in. Well, the first one that I have for you is according to the Florida State Constitution. Okay, not any other state. It's according to our own
Please state the
Constitution.
statute.
Article 7, Section 1A, and this is according to the taxation
Of what statute?
appropriations.
I'm sorry, what statute?
No, this is the Florida State Constitution articles.
Okay.
Yeah, Constitution
Articles.
articles, right?
Thank you.
Section 1, and is according to the taxation appropriations and state revenue limitation. So they have a limitation.
Very nice to know.
So no state ad valorem taxes shall be levied upon real estate or tangible personal property.
Now, who comes to the definition of what is ad valorem?
Well, that is a Latin word, and
Right.
that is another great story. They like to use a lot of Latin, so we don't understand, and we
Yeah,
get
keep us
confused.
stupid
Yes,
or uninformed.
yes. But thank goodness for the angels that we have right now, that a lot of people are finding all this information and giving it to us, putting it out there for us on internet, so you can go online and find all this information, because right now you can go online and for free you can download your PDF for the Florida State Constitutions, and you can read the whole thing.
But
Okay?
we're going to have it up here on the screen as well.
Yes. So number 2, according to Florida statutes.
Here he comes.
Okay. Subsection 196.192, exception from ad valorem taxation. It says here, all property owned. Not this one nor that one, just a little bit here. All property owned by an exempt entity.
They throw a blanket over it.
By an exempt entity and used exclusively for exempt purposes. In other words, you're not using it for business. Shall be what? Totally exempt from ad valorem taxation. All your property, as long as you don't use it for commercial purposes,
Right.
shall be all exempt, totally exempt from ad valorem taxation. Another one, which is right there in the same statute, says right below, all tangible personal property. Is your land tangible? Can you touch it? Can you grab some gravel from your land? It is tangible,
It is.
right? All right. So all tangible personal property loaned, and normally we take a mortgage to buy our home. All tangible personal property loaned is exempt from ad valorem taxation.
So then why do we pay taxes to the county and the state? Because they say that in order for us to provide you with quality fire rescue, quality policing, which I don't think that exists anymore, we have to collect taxes in order to pay for those services and provide them to you.
Okay. Okay, let me give you the last one. This is Gray. I'm going to answer that one.
Please.
I will answer that one. So the last one, this is a law case because I told you that I was going to bring you all all the information is coming from main sources, including case laws.
As I say in the beginning of every show, we're not here to opine or make things up. We're here to repeat what is actually tangible and in the law, where you can actually see it and read it for yourself.
Factual information from the main source. And this one is coming from Gray and Winthrop. This is a case law in Florida from 1934. They used a 1933 House Joint Resolution for this one. Extremely interesting. It says here, a state may not tax persons, property, or interests which are not within its territorial jurisdiction. Remember that jurisdiction, because do they have jurisdiction over us? Is that what it is? Is that the reason why they're actually taxing us? That is the other main question. Jurisdiction. Do they have jurisdiction over us? Now, number one, the amendment that I read to you before, the 16th Amendment to the U.S. Constitution, where they give the Congress all power to tax people. It was actually never ratified. It had too many errors, and only 2 states ratified that amendment. But you need 36 states.
So basically, what it's called a dive in the floor.
Exactly, that's what it is. And this is a funny thing. How was this found out? Okay, well, there was a case, the case in Indianapolis, Indiana, run by the attorney George Duncan. That was the U.S. attorney, and the attorney for the defense attorney, Lowell Bigcraft of Huntsville, Alabama. He presented irrefutable evidence that the 16th Amendment of the U.S. Constitution was never properly ratified.
Now, an interesting thing here that I'm reading from your computer. It says here, in April 4th, 1985, Roscoe Edgar Jr., the commissioner of the IRS during the Reagan administration, and Reagan was a big advocate about reducing taxes and smaller government. How did that fare out? Because you said here that was never ratified. So how could it be enforced?
Well, the actual commissioner, Roscoe, at that moment, he saw the case that I was just telling you about with Lowell Bigcraft, and he immediately wrote a letter to all the district directors of the IRS and the Treasury.
And he's the boss of the IRS at that time.
Yes, he is the boss. So when he found out that this lawyer, this attorney, won the case, because the case was dropped immediately, because there was absolutely no proof that the 16th Amendment of the Constitution was properly ratified. So he said, oh my gosh, we need to fix this, because once people start knowing this, we need to run, because we are going to have to give the money back, to refund all the money starting from 1913. You can actually get a refund by using a simple form such as 1040X. Again, this is not legal advice. You need to study, do your investigations, and talk to an attorney, a tax attorney for this. But you have right here, you have a very good tool that you can actually find out. There's a free PDF that you can download and study it, okay? But what happened after that? He only stayed there for 5 years, the commissioner.
That's a long time for an IRS commissioner.
And you know what happened? They got, according to the story, because this is a case law that I read, according to the story, that they brought a lot of computers to put all this information, but since they were so new with the computers erased all the data.
Seriously, let's take a. We gotta dig into this deeper. We're gonna take a break and we're gonna come back and dive into these extremely interesting information because this could affect and improve your quality of life standards.
Absolutely.
Thank you and God bless you. We'll see you very soon.